Hello and welcome again to Money Talks with me, George Pitcher, and a great pleasure as ever to welcome Ed Shing of BCS Asset Management and the Idle Investor website. Welcome, Ed.
Thank you, George.
You've written about this totemic event of our FTSE index breaking through the 7,000 mark again, but I gather that you're a bit phlegmatic about that. It's not really so impressive for you.
Well, it's just a number, isn't it, George? Why should 7,000 be so important? Yeah. And the only reason it is because we nearly touched it back in 2000 and we haven't got near it since.
Well, yeah, back in 2000 it was inflated by that extraordinary dot-com boom, which was an empty bubble that popped. So is the UK market overinflated?
I wouldn't say so, George, because again, think of it this way. In between 2000 and 2015, we have 15 years where earnings generally have gone up. So companies have become more profitable in the UK. So actually, this time around, I would say the level of the index indicates that better profitability. Whereas back in 2000, it was not justified. I think it's much better justified today.
Oh, so it's built on sturdier foundations now.
Exactly.
But not many people are invested in it, I gather.
No, that's right. I mean, the interesting thing is only 18% of net household wealth in the UK is in any form of stocks and shares or funds in stocks and shares.
Yeah.
Most of our money is in other areas. Housing, obviously, and private pensions. Those are the two biggest areas, and they represent, together with insurance policies, 77% of our net household wealth of the entire country.
Well, what happens next when the FTSE hits these sorts of heights? Does it fall off a cliff? I mean, is it going to go on and on?
Typically, momentum engenders more momentum. So in other words, things that go up, bizarrely enough, tend to continue to go up. And I think the problem here is that the retail investor, the punter in the street, tends to get in on the act rather late in the day. So the risk is that they start to get in now. And I think that's fine. I think it will go up further. But always the risk is, are you coming at the end of the party?
Well, the UK stock market's doing well, but I gather some other European stock markets are doing even better.
If you look across to continental Europe and you look at something like Germany, where you have a DAX index of the top 30 stocks, at the same time that the FTSE's doubled from 2009 to now, it's trebled. So it's done a lot better in Germany than we've done here because they have a lot of really top quality stocks like car makers, BMW, Volkswagen, Daimler, who make the world's best cars.
And if you're a fan, as I gather you are, Ed, of momentum in stock markets, that would seem to imply that the British stock market investor should be looking abroad to continental Europe for some punts.
Exactly. This is exactly what the US investor is doing at the moment. They are selling US stocks and buying continental European stocks, and I think the UK investor should do exactly the same and invest. I've put an ETF in the article looking at the MSCI Europe ex-UK index, which basically says buy the whole of continental Europe, excluding the UK.
And what about a particular stock? Have you got a punt for us? There must be companies in the UK that are exposed to European trade rather more than others.
There's a lovely little small cap company called British Polythene, code BPI, which has 60% of its profits coming from Europe. It's an industrial company on the up. Forecasts are being revised up, so earnings power is increasing, and it's still very, very cheap with a PE ratio of under 10, which is way cheaper than the UK market today.
Very good. So there we are. British Polythene is Ed Shing's punt to take advantage of that buoyancy in continental European stock markets. Thank you very much, Ed. Look forward to Ed's next column and visiting us here in the studios at IB Times UK. And thank you very much for watching, and see you next time.